Chapter investors. Miami Indians Club. Yeah. What's up, Diego? Thank you for joining. As always, video and audio is not mandatory. So if you want, you can listen. I mean, if you want, you can speak. If you want, you can show yourself. Not mandatory.
Hi, our team.
Yeah.
How are you?
I'm good. What about you? What's up, Diego? Nice to see you again.
Nice to see you, man. I was desperate, like, where do I find the link to the webinar?
Yeah, the link is always the same. It's the weekly recurring webinar. So link is always the same. But I will always be sending it again every single time on Instagram in the group. So for those people who lose it or anything.
Oh, okay.
Yeah, let's see if more people are joining.
I wanted to ask you first. This webinar is recorded?
Yes, yes. Every single webinar I will be recording, and then I will be posting these webinars on the Patreon and YouTube. So basically, if you have any questions during the week, but you cannot participate, you cannot see the answers for them, you will be able to see the recorded webinar basically, and your questions will be answered.
Oh, perfect. And where is this uploaded?
Patreon, yes, the same.
Okay.
Yes, I will also be uploading it on YouTube. Hello, Travis. So I will also be uploading those things on YouTube. In case. What's up, Vlad? What's up, Vlad? Thank you for joining. Just waiting for people to join. So yeah, what I was saying is that all these meetings are recorded. Videos and audios are not mandatory unless you want to. Basically, it's just me presenting, and then in the end, I'll be answering questions. So up to you if you want to show yourself, if you want to speak with the microphone, or you can just use chat, whatever you want. All the videos, all the meetings will be recorded, will be uploaded on my Patreon. So just in case if you had some questions, I will be answering them. Doesn't matter if you are participating in the actual live meeting or not. I will still answer all your questions you had during the week. And whenever I upload those meetings, you will be able to see the answers to your questions, basically. I will be uploading those meetings, like I said, on my Patreon and YouTube. And I will be using like timestamps. For example, like whenever Q&A section starts, for example, 33 minutes, 46 seconds. So I put this 33:46 Q&A starts. So basically you will not even need to see the whole meeting unless you want to. You can just go skip to the Q&A section, wait for your answer, and basically that's it. Or if you can see the whole meeting, it will be better for you, for me. So you are learning here, so obviously it's better if you see it all. So yeah, 5 people joined already. Let's see if somebody else joins, but I think we can already more or less start. 5 is good amount to begin. So yeah. Okay, so today's topic, we're going to be talking about the very basics of investing, where basically beginners should invest. Obviously, every single topic I'll be talking in our weekly calls, every single topic will be different. I will not always be speaking about beginners or about this, about that. So I will always be trying to speak about something new every single time, basically, yes? Let me just do one thing really quick. Okay, so I will be always basically speaking about different topics, and the structure of our meetings is that in the beginning, first majority of time of the meeting, I think our meetings will be like 45 minutes. So let's say, so 20, 30 minutes, we will be talking about the topic of the week, which today is where beginners should invest. Then it's like Q&A section, basically whatever people were asking me during the week, I will be answering these things. And the last 5-10 minutes, whatever time we have left, this will be the questions like about this meeting. Like if you have something, you can ask in the chat, or you can use microphone, whatever is more convenient for you, you ask these questions. And obviously, whenever during the first part, during the topic introduction, if you have any questions, you can stop me. I have my chat opened. Yes, I just opened. So if you want to learn something, if you have additional questions during the meeting, Feel free to ask in the chat or use microphone, whatever once again is more convenient for you. And basically this is how we go. So like I said, this week we are talking about where beginners should invest. The very, 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 very basics. And in my own opinion, and in so many other people's opinion, it is very good for investor to begin with ETF. ETF is exchange trade fund. This is basically like basket of investments. So there are two types of investments you can do. The first one is investing in individual companies, which is basically investing in Apple, investing in Google, individual companies. It's self-explanatory. And the second thing, one more person joined. Okay. And the second thing, you can invest in the ETF. ETF, like I said, is the combination of investments. This is you are investing already in assembled portfolio. For example, if you're investing in just in Apple and this is your only company in your portfolio, your whole portfolio performance will depend on the performance of just one company. It may be very good, like Apple can be increasing 200% per year, but it is still just your exposure just in one company. Just in case something happens, it goes bankrupt, in case there is like some scandals, in case there is something else, in case there is something bad happens with the company, and it's the only company inside your portfolio, the whole portfolio goes down with this company, obviously. So like Carnival or Intel, whenever they introduced their that they were delaying their new chips like months ago or something, the whole Intel stock decreased like in one day, approximately like 20% or something in just one day. So imagine if you'll be investing in Intel. On the one hand, Intel is pretty big company, it's famous company. You'll be thinking like, well, it's Intel, it's not gonna fall, it's big and strong company. And here you go, one news, in 2 days, the whole company lost 20% of its market capitalization. So it is very important to diversify. Basically, the less companies you have, the more risky is your portfolio. If you have just 1, 2, 3, it is pretty risky. But if you have like 10, 20, 30, and especially if those companies that you have from different sectors and industries, it is very, very, very good protection for your whole portfolio as a whole. For example, it is not necessary to have like 50 or 100 companies in your portfolio. No, you don't need to have anything like this at all. It is so much work to maintain such portfolios. But it is more than enough to have at least 10, I would say. Me personally, I am planning to have about 23 companies. Right now I have just 14, but my portfolio at this very moment is short/medium long-term portfolio. Because my current portfolio, I'm planning to do to get the down payment for the house, basically. For this reason, I took a little bit more risk. So for this reason, I took like just 14 companies. 14 companies is like bare minimum, like 10, 14 is the bare minimum amount, I would say. And I try to split them across all sectors. I have one company from basic materials. I have one company from utilities. I have 2 companies from technological sector. I have 1 financial sector. So I am spread across all sectors. And each company, since I have 14 companies, each company, I try to keep it 7% of my portfolio. Like 100% divided by 14 is like 7 and something. So I try to keep all this company within like 7% range. So basically the portfolio is well balanced. It maintains itself. Whenever something goes down, I don't feel it that much. Let's say so Intel fell 20% and I do have Intel in my portfolio. Because Intel is just 7% of my portfolio and this 7%, it fell 20%. So long story short, my whole portfolio, just because of Intel, the whole portfolio decreased just by 1.4%. And that's it. Like, can you imagine if you have just Intel, your portfolio will be 20% less. But because I'm diversifying, Intel fell 20% and I just lost 1.4%. That's it. This is the importance of diversification. So speaking once again where investors, beginners should invest, in order to have portfolio which is combined of individual companies, obviously you will need to do fundamental analysis. And I will definitely teach you every single thing I know about fundamental analysis. The purpose of the fundamental analysis is to find companies which are in pretty good health, in pretty good financial condition, financially strong, which financial statements are improving, or at least they're not decreasing, falling that much comparing to its competitors. So the purpose of fundamental analysis is to find good investments. And I'm talking about long-term investments, because the whole idea of my project is to teach people how to invest like classic investments, value investments, long-term investments. I'm not teaching here trading, even though I remember I have a question about puts and calls, and I will talk about them in the end. The whole project for me is long-term investment. The investment that's been existing since the beginning of stock exchange, since when it appeared in like 19th or 20th century, back in London, the first stock exchange in the coffee shop. Since that time, it was already value investing, finding good, strong companies, investing for them long-term, and then enjoying the benefits. Trading, all these kind of things, it all appeared later. And so these strategies that I'm talking about, that I will be talking about in this project in our weekly calls, these are the strategies with the proven hundreds years of experience of lots of people are using them. Buffett, if you want to call it, like Benjamin Graham, Peter Lynch, all of those people are using classic value basically investing. And the idea of this, like I said, is to find good investments. But since you're beginners, most of you are beginners, and most of you don't know yet how to do fundamental analysis, there is still a solution for you. So I was talking about ETFs. The first of all, it is very important to start investing. So in the meantime, while you don't know how to do fundamental analysis, but you can already make very, very, very good investment decisions. And this investment decision is basically invest in ETF. This is the combination of stocks. Like I said in the beginning, this is the basket of the companies. This is like 500 companies in one place, 100 companies. There are so many different ETFs. Like one of the most famous ETFs are the one that track S&P500 index. And S&P500 index, those of you who still don't know what is this is 500 largest US companies. So all these Amazon, Apple, Google, Facebook, Nucor, AbbVie, all these companies there are in S&P 500 index. And this index, since it is 500 biggest US companies, this is representation of 70-80% of the whole stock market of the US. So long story short, investing in this index, in S&P 500 index, is almost equivalent of investing in the whole economy of the United States. And it is kind of relatively safe investment. It is a relatively safe investment in terms of investments. There are not a single investment which is 100% safe. Like I said, Intel, big company, everyone knows Intel. Like you all have laptops that say Intel inside. Still, it took 2 days to lose 20% of it. So basically, there are no 100% safe investments. Okay, so now let me see the question from Diego. Oh, we are going to select our companies from S&P 500 index. This is not exactly the right thing to do because it's a lot of work. But instead, you can invest in this S&P 500 index. And like I said, this is a relatively safe investment for the beginners because you need to start investing as soon as possible. You do not need to wait until you have 20, 30,000. You do not need to wait until you have 6-figure salaries. The thing is about starting as early as possible. And while you still don't know how to do fundamental analysis and invest in individual companies, the best you can do is to invest just basically in index. Okay, now let's see, Divyank asks the question. How often companies in S&P 500 index change, like monthly, quarterly? So it changes basically instantly. It depends. As soon as company is not that big anymore, let's say, so as soon as the company is like, as soon as the company does not meet criteria, it automatically leaves the index. For example, one of the criteria is to have positive income, basically, yes, to make money, basically. I'm not going to say like revenue, earnings, income, very confusing. One of the requirements in order for the company to be included in the index is to make money, not to lose, but to make money. And if the company is big enough, like I said, it's 500 biggest companies. If the company is big enough, if the company is making money and some other criteria are met, then this company automatically is included in the index. And those people who create ETFs, which are following, tracking those index, they automatically include these companies inside this index. You do not need to track like 1,000 American companies, and as soon as company leaves or enters the index, you need to do it yourself. No, you do not need to do such things yourself. Those people who create those ETFs, those people who create those like indexes, basically, yes, they do everything for you. So let me see once again question. What broker do I have? Do you recommend the same one? Okay, so right now I have Wealthsimple, and it's the broker that's available in Canada, USA, and UK. So unless you're from these countries, you cannot use Wealthsimple. But I will tell you about all the other brokers in the end. Let me put down this question in our Q&A section. Okay, online brokers. Okay, so now back to indexes, back to S&P 500, back to ETFs. So once again, third time, what is an ETF? ETF is the combination, it's the basket of investments. This is like literally like you invest in already assembled portfolio, which is managed for you. So you do not need to keep track which companies enter index, which companies are leaving index. Everything is managed for you. For this reason, you pay a little fee, 0.03%. One of the most famous index that tracks S&P 500, it's from Vanguard. I guess some of you heard about this. And it's called VOO. I'll put the name of it in the chat. This is how you find it. So you have your online brokers, you type VOO in the chat bar, and that's it. You will be able to find this index. And most online brokers, they have access to this. So the management fees for this index, as far for now, like 19th of August, it is 0.03%. So if you invest $10,000, every single year you will be paying $3, just $3 in management fees. And for these $3 out of 10,000 invested, they will be, like I said, managing your portfolio. They will be managing your portfolio. They will be adding companies to the index. They'll be removing companies from the index. They will do everything for you just for $3 per year. This is the power of ETFs, investigated ETFs. Like I said, this is the portfolio that smart people create. I don't know, from Wall Street, from any other place, but these are ETFs that track the performance of the US economy, such as S&P 500 index. And that's it. It's literally one investment and that's it. You are done. For example, me personally, I am investor in individual companies. Hi, Michael. I am investor in individual companies. And for me, it takes maybe 2 hours per month to rebalance, to adjust, to edit my portfolio, to see what I need to buy, to what I need to sell, if I need to buy something, if I need to sell something. It takes 2 hours per month. This is my whole investing experience, like practical experience. But if you invest in ETF, which I highly recommend you to do as a beginner, it will literally take you 5 minutes, because what you will need to do, as soon as 1 month passes, you just go to your online broker, you type VOO, for example. Like I said, most online brokers, they have access to this index ETF. You just type VOO, you buy 1-2 shares, you're done, that's it. You do the same next month. So basically, that's it. It's as simple as it gets. Every single month, you buy 1-2 shares of this ETF and you are done. So because of this, why it is important to invest in like indexes like this, either S&P 500 or total market index. Total market index, it involves every single company. So there are total market index for USA, for Canada, for other countries, and it is literally every single publicly traded company of the United States of America. So it is too much diversification in my opinion, but still the returns are approximately the same. So it is more better, in my own opinion, once again, it is a little bit better to invest in S&P 500 because once again, these are biggest US companies and those are the companies with proven track record of success. These are big tech giants. So technically S&P 500 returns a little bit more than total market. And for this reason, S&P 500, like I said, it tracks the performance of the whole US economy. And on average for 90 years, this index has been returning 9.8% annually. This may sound like a little, like, you know, like all these like crazy traders, they say, I can make a 4,000 return on investment, 4,000% in 1 week, explode. Yes, like Michael is showing, just give me $500, I'll make 50,000 in 1 month. Like, it's a gamble. It's literally a gamble. You can take the same $50, go to casino in Vegas, and it's gonna be the same. But at the same time, if you go in the casino in Vegas, like technically you can still win, because like what chances are 1 in 36. But when a guy like promises you to make huge amounts of money, he'll just take your money and you'll never hear from him again. So it is extremely unusual for a person to make more than 100% return every single year for 5, 10, like 15 years. Eventually, this person will get greedy. Eventually, this person will lose whatever he make. Like, I have a personal experience. One friend of my father, like it always happens, he is a trader. And in 2012, I think 13, like it happened back in Russia, okay? So it was like he was trading Forex, foreign exchange, foreign currencies. He was trading the difference between Russian currency and US dollar. So eventually he was trading like since the beginning of 2003, if I'm not mistaken, yes? And I'm not remember exactly the year. I think it was 2013 or 14. So he got so greedy. He was winning, he was making like double-digit returns. Like I said, market returns 10% on average, 8, 9, 10% on average annually. And this is the proven track record of 90 years plus, like reported period. So the guy was making double-digit returns for 10 plus years. And he obviously got greedy. He's like, why would I need to invest in stock market just to get 9%? I can trade Forex and I can make 30, 40% every year. He got extremely greedy. So there was like event, I think it's called like Black Tuesday in Russia, something like this. You can read about this. I can even find the article after the conversation and include this in the Patreon. So long story short, he was trading USD and Russian currency Forex. And then literally something unexpected happened. It was a like technical mistake in the reporting system of the bank in Russia. It was literally just a mistake, computer mistake. Like nothing was, the day started good. There was no big events, no news, no wars going on, nothing like this. It was just simple mistake in the computer, in the software or something like this in the Bank of Russia, in the National Bank of Russia. So the thing got worse. Like he was already trading on margin, obviously, like 10x margin or something like this. I'm not a trader, so that's why I may say random stuff, but so he was trading on margin. Basically, those of you who know what is margin, this is when you have like your $100 of your own money and 10 times margin. It means that you borrow like $1,000 from your broker. You borrow 10 times the amount of what you are trading. So for this reason, you magnify, you amplify your returns. But at the same time, if you lose, you will be forced to close your position and you will be forced to literally pay out of your pocket. So long story short, the guy in one day, he lost like $150,000 approximately. He was, like I said, he was making very, very decent returns for 10 plus years. And that's it. He was like, that's it, I'm unstoppable. $150,000 for Russia. This is almost like equivalent of million for first world countries. It is extremely big money for Russia. And he like, that's it. In one day, he erased the performance of his previous years. He still got some money left from these 10 years of trading experience. But in one day, he completely erased 8 years of progress. So this is what I'm saying. Yes, you may trade. I'm not going to restrict you, but at the same time, I'm not going to teach you this because I do not believe that you can make good money in long-term perspective with trading. The longer you trade, the less chances you have to win against classic investing. Classic investing may bring you smaller amounts, but it's like slow and steady. So once again, coming back to ETFs, this is what it allows you to achieve to be classic long-term investor with minimum amounts of work. Because on the one hand, we have traders who is literally, it's their day job. It's their literally 9 to 5, and I think Michael can confirm. You can even work 7 days per week. On the weekends, you look for the next week opportunities, basically. And then you just trade. If you're investing in ETF, you literally spend 5 minutes per month. Like you have like $1,000 per month spending limits, let's say so, how much you want to invest. Every single month, you just spend this $1,000, you're done. So since this VOO, if I'm not mistaken, it's like $400 something to $300, I think, yes? So if you're investing $1,000, I can just check, yeah. VOO. Right now it's $310 US dollars. If you're spending $1,000 every single month on investments, and this is dollar cost averaging, I will talk about this later as well. So you just need to buy 3 shares of VOO, done, that's it. 5 minutes, you're done, you're an investor. So, and once again, like I said, it returns on average like 9% approximately per year, plus there are dividends, and like if there are like good years, you'll get more obviously, if there are bad years, you will get less, or you can even get negative returns in 1 year. But like I said, 90 years of the performance of the index annualized on average approximately 9.8%. So, and this is as easy as it gets. So one of the most famous ones, like I said, is VOO. This is the performance of the S&P 500 index, the one which tracks 500 biggest, the best companies of the United States of America. You can also invest in total market index and all these indexes. So I don't spend time looking for them now, and I'm not flooding, spamming in the chat. I will include later in the description under the video whenever I upload it. But for now, the best one is VOO, the one that I found so far. And like I said, the expense ratio is 0.03%, which is literally $3 on every 10,000 invested. So it's literally as best, as good as it gets for the beginners. No fundamental analysis, no qualitative analysis, no nothing. Just you spend $1,000 every single month buying the same stuff. You do not care if the market is up. You do not care if the market is down. If you're investing long-term, 20, 30 years, you do not care where the prices are right now. Every single recession, Great Depression, the tech bubble of beginning of 2000s, 2008 financial crisis, 2018 small correction, coronavirus, today coronavirus, everything that was lost during coronavirus, everything on the market was returned. So today S&P 500 again on its maximum levels, and that's it. The virus is still ravaging outside, but markets are already on the pre-virus levels. No matter what happens, the market will beat everything. Like if market will not be able to beat this, if the market will not be able to recover, it means that the economy of the USA collapsed, which means that something extremely bad happened, which means that you will maybe not even need money anymore. Maybe everyone will be using cryptocurrencies. But so technically speaking, if market is not recovering, it means you will just not need money anymore. And like, that's it. If you're invested, if you haven't invested, money will just literally become paper. So that's it. Market, financial system of the world collapsed. So there is no point using money anymore. So markets will recover. No matter what happens, markets will recover. So for this reason, once again, I'm saying it is as safe as it gets from investing perspective to invest in ETF, which tracks S&P 500. And this S&P 500 ETF, once again, how I text in the chat already, is called VOO. It is available in major online brokers, in Wealthsimple, Robinhood, Trading 212, everywhere in these platforms, it is available. Expense ratio is extremely small, you can invest, and that's it. Enjoy the benefits of investing. Why it is good for beginners and why you should do it now. One last thing, I guess, before we go to the questions. So once again, like I said in the beginning, the thing is not about waiting for the perfect opportunity to invest. The thing is about finally starting to invest. Because while you're waiting, while you're thinking right now, okay, markets will be lower tomorrow, but what if it goes higher? And yesterday, which is today, you already lost the opportunity to buy cheaper. Yes, you may be right, and tomorrow the prices may go higher, but you never know this. It's literally 50-50. Not anything can happen every single day. So assuming that you're going to be investing long-term 20-30 years from now, the market will be 99.9999% higher than it is right now. So right now is the best time to invest. Yesterday is the best time to invest. Today, tomorrow, every day is the best time to invest. And basically, this is how it is. This is the investing for the beginners, ETF, S&P 500, VOO. That's all you need to know. In the meantime, while you're investing in this, we continue with our weekly sessions. We continue, you can ask me questions. I teach you, I write articles, do fundamental analysis. I teach you how to do fundamental analysis. So those of you who are interested in investing in the individual companies, for me personally, it is way more fun. So for me personally, it is way more fun to select companies, to see them grow, to bet on them. I may be losing, I may be winning, like I may be achieving less return than the market. I may achieve more return than the market. I do not know this, but it is just more fun for me. I just like it like this. And in the meantime, I'll keep it like this. So right now, ETF, focus on ETFs, VOO. And then, like I said, I will be teaching you how to basically do fundamental analysis and how to select your own individual companies. Okay, so now questions from the week that I was getting first from the week. The first question was by Divyang. What are market orders? So yes, he is using Wealthsimple, and Wealthsimple, Robinhood, and Trading 212. These are three major platforms that I'll be talking about during my all sessions. Why? Because Wealthsimple is one of the best in Canada, Robinhood in the USA, and Trading 212, it's literally like almost everywhere. It's international, one of the biggest international online broker. So all the people who are joining right now or in the future, 99.9% of them will have access to either of these three platforms. So for this reason, for me, it makes sense to always just use them. So in these platforms, whenever you're buying shares, there is always a selection just before you submit your order. You can select which order type. And there are three order types. First one is market order. The second one is limit order. And this is as far as it gets in Wealthsimple. But there is also stop limit order, stop loss, if I'm not mistaken. Yes, I'm using Wealthsimple. I'm using just market order. That's why I know what they mean, but I don't care about them. Why? I'll explain now. Market order, the most popular one. If you're a long-term investor, if you're investing in ETF, this is all you need. Market order is whenever you submit the order to buy shares, VOO, Apple, Microsoft, Amazon, at this point, for example, you see that Apple price, to be even super extremely precise, let's see it right now. Apple price right now is $464. So $464.42 is the current at this moment price of Apple, one share of Apple. So if you submit market order, your buy order will be executed as soon as the online broker finds someone who is selling this share. So it may sound confusing, okay? So market order, once again, as soon as you submit market order, your online broker, an online broker, it is Robinhood, Wealthsimple, Trading 212. As soon as you submit market order, you will buy shares as soon as possible at whatever price possible. So, but because Apple, because Microsoft, because Facebook, because all these big companies, their shares are traded millions per day, you will find someone who is selling share immediately. So basically, if you're using market order and you're buying popular company shares, the price that you will buy will be like 99% of the time, so will be the same price that you see right now. And I think I saw the question from Michael, if I'm not mistaken. Yes? You can ask.
When you execute the market transaction, then you just go for the closest order in the order book, because there are already some orders in the order book.
Yes.
Up and reds down. So you basically buy what is on the market already now. So
yes.
You are buying market price.
Yes. You buy share which is available like as soon as possible. So the first share that becomes available, you're taking it. But once again, because if you're buying popular companies, the price will be approximately the same, the one that you see. It will be the same price that you see right now. But if you're buying some, like, I don't know, startup or recent IPO, like the company that trades only like 10,000 shares, for example, and it's like literally just 10 people on the market, on the whole market, there are just literally 10 people who buy or sell these shares. So you see that the share price is $50 and you submit market order to buy, and that's it. You submit market order to buy, but there is no one selling these shares at this price at the moment. So market sees it and automatically adjusts the price. So it motivates those people who already own the shares, it motivates them to sell it. So basically you submitted your order and you said, I want to buy ABC company at whatever price, I want to buy it as soon as I can. This is what is market order. But there are not a single person selling those shares for $50. So market raises the price. Now it's 55. No one still buys them. Then there's 60. No one still sells them. I mean, there's 65. No one still sells them. And then it's 70. And one guy's like, wow, my shares are $70. I'll sell them. So he offers those shares for sale. And even though you bought shares for $50, the first available share, it is $70. So for this reason, even though you wanted to buy it for 50, but you actually ended up buying them for 70. This is what is market order. To buy a share as soon as possible at whatever price it is. But if you're buying big companies, like popular companies, this does not matter at all. Literally, there are millions of shares traded on pre-market hours. Like before even market is open, Apple, like all these big companies, they trade millions of shares even before the market opens. So it does not matter if you're buying big company or this VOO. VOO is also very highly traded, very actively traded company. So if you want to buy VOO, just use market order and don't even worry about anything else. So this is what is market order. Limit order at the same time. This is already if you're a trader or if you're buying the smaller company. So once again, you have $50 share of ABC, and this is a relatively small company, but you still wanted to buy it. So you press buy, and then you press limit order, and you select at which price you want to buy it. So right now the price is 50. So you put 50, for example, yes? And then once again, that's it. Your order is registered, and your online broker waits until someone starts selling those shares for $50. So once again, no one sells. So the market goes for 60, 65, 70, and one guy sold his shares. But because yours is 50, you do not move to him. You still do not buy shares. So market sees that there is demand, but there is no supply. But now there is supply, but there is no demand. So he also sets this order. And because, for example, if he said market sell order, so even though he thought he thinks that he sold it for 70, but because there is no buyers already at this moment, his share will go down until it meets your limit. So now at this time, he is the one who lost. He wanted to sell it for 70, but he ended up selling it for 50. But because you had limit order, you will never pay more than what is your limit order. Once again, limit orders is something that you do not need to care if you're investing in big companies or ETFs. Limit orders if you're a trader, if you are investing in smaller companies. But if you're a big investor in big companies, in big ETFs, always 99% of the times just use market order. Don't even worry about anything like this, and that's it. You're good to go, literally. And there's any other orders like stop loss, stop limit, trailing stop. Like this is take profit order. Yes, all these kind of orders. This is not even all the online brokers have access to these orders. So I would definitely think we don't even need to waste time on them. I can still make one of my future weekly calls focused on orders, just in case those people who are want to try themselves in trading or anything like this. I can still, if I see that people are interested, I can still make one more presentation about order types. But 199% of the times you'll be using market order. The rest of the times you'll be using limit order, unless you're a trader, which once again, I'll be not teaching how to trade. Okay, next question was online brokers. Also from Vlad, if I'm not mistaken, who already left, or he, Vlad Suljan. Is it you, Vlad, from Income Doctor Vlad? Okay, so online brokers. Online brokers, once again, the one that we'll be talking about here the most are Wealthsimple, available in USA, Canada, and UK, the one that I'm using. Robinhood, notorious Robinhood, mostly available in the USA, and Trading 212, the biggest, if not the biggest online international broker. You will have access to one of these three, almost 100%, I will tell you. Like unless you're from Somali, Mogadishu, unless you're from Iraq, like these are the countries where you may have to look for something else. But if you're like from pretty famous, I don't know, big countries, like even if you're from like South Africa, like I don't think we have anyone from South Africa yet, but those countries, they still have access at least to trading 212. Very, very popular broker, very simple broker to use. And one last question from the week was by Travis by options and put, about options, basically put and call options. Also pure trading instrument. Options, puts calls options. Options is the name. Options is the category of these financial investing instruments. Yes, so puts and calls are options. So, and put, the difference between put and call. Put, whenever you wanna sell share, you set the price. It gives you the right, but it's not mandatory for you to sell the share, okay? Once again, this is pure trading instrument. I'm not using them. I will be telling whatever. So put option is the right, but not responsibility for you to sell the share, or like whatever you're trading. It can be derivative, like whatever, yes. So it is the right to sell the share, let's say so, at the specified price. So for example, I think the best thing is the examples. So you have, once again, shares of Apple, and you make the put option to sell shares of Apple. Right now, they're like $464, if I'm not mistaken, okay? So you save this right, to sell those shares for $464. So just in case, if you find someone buyer of your put option, basically you will profit if the price goes down. Because long story short, if the price goes down and now the price is $450, but you have the right to sell it for $464, and the person who bought it, he has to buy it, if I'm not mistaken. So even though the price right now is $450, but you still sell Apple shares for $464. So this is literally betting that the price will go down. And the call option is exactly the opposite. It's the right to buy the shares, let's say, so share apples. For example, the same Apple, yes, you buy you buy call option for $464 for Apple, current price of Apple, and you will profit if the price of Apple goes up. So you buy call option for Apple at current price of $446, and if 2 days later the price is $480, you can still buy shares of Apple at $464. So this is, like I said, gives you the right, but it's not mandatory. You do not need to execute this like trade, basically. It gives you the right to buy or sell at price that was 2 days ago, whenever you made this option. So yeah, I will do more research if it's more interesting about puts and calls, and we can once again do a separate video call, our weekly call, and just dedicated to puts, calls, and other maybe basic trading terms. But this is the very basics of it. Once again, you reserve the price that is right now, and if the price changes, you will benefit from the price changes in the future, either if it's call or put. Let's see if there are any more questions of the week. Yeah, yes, one more last question before we can go for questions from the meeting. So the question, once again, was from Divyang, the difference between VOO, which is ETF, S&P 500 ETF, and VFV. This is also S&P 500 ETF. So VOO, it sells S&P 500 index ETF, but it uses US dollars to buy and sell it. So you can buy VOO for US dollars, the currency for this. But for VFV, let's see, yes, VFV. But for VFV, it is the same index, but the price of this is in Canadian dollars. So the most obvious difference, obviously, is in the currency exchange differences, in the currency exchange rate. If you are buying using US dollars, just buy VOO. That's it. You see that the price is like 310, you'll pay 310. But if you're using Canadian dollars to buy VOO, for example, if you're buying VOO from your Wealthsimple account, which is in Canadian dollars, so you will, it will apply exchange rate of Wealthsimple to this trade, which is a little bit worse than the original exchange rate of the official exchange rate of the country. But still, it's pretty decent. If I'm not mistaken, Wealthsimple uses the best exchange rates among all the other Canadian online brokers. So once again, if you are using Canadian dollars to buy US dollars ETF, you will lose a little bit on exchange rate, but it's decent. It's worth it, basically, long story short. And at the same time, yes, if you buy using US dollars, if you use it to buy ETF, which is traded in Canadian dollars, then you once again will lose a little bit on the exchange rate between US dollar and Canadian dollars. But I was reading about this, and there's also very interesting stuff. At the same time, you'll be thinking, okay, so if indexes are the same, why would I lose some money and buy US dollars ETF, basically? Yes, like technically it's correct, but if you're buying with the Canadian dollars, it is very complicated. I know, like, you may lose me during this monologue or whatever. So because ETF for S&P 500, it includes US companies, okay? US companies, they are traded in US dollars, but ETF is traded in Canadian dollars. So because of some legislation of tax reasons and some law and agreements, investment agreements between these two countries, whenever you use tax benefits account in Wealthsimple, it's TFSA. Whenever you use this account, you do not need to pay any taxes or dividends or on capital gains. It's as simple as it gets. You have contribution limits, but you do not need to pay any taxes at all if you're using tax benefits account. But if you are buying ETF in Canadian dollars, which tracks US companies in US dollars, then this right is waived. So even though you're buying this using tax benefits account, you still need to pay dividends, taxes on dividends and on capital gains. Sounds extremely stupid, but this is basically how international law works. This is why they make it all so complicated and stupid, but this is how it is. For some reason, maybe it's like a flaw, maybe it's something else. I didn't go do that much deep into this, but if you're using Canadian dollars and you're buying Canadian ETF, but which includes US dollar companies, even though you're using tax benefits account, you will still need to pay taxes. Besides all other like legal stuff, like whatever it is, whatever is that. So you may technically save some money, but if you're not buying hundreds of thousands of dollars worth of investments, if your investment is just, I don't know, $100, if your investment is just like $1,000, this hassle that you're going to experience in the future because of the taxes is not worth it. Literally, you can just invest in the VOO, which is in US dollars, and you may lose, I don't know, I have no idea, I'm just guessing, like $2, let's say so. But if you invest in Canadian dollars and you will need to pay taxes, you will need to pay like 67 cents of taxes. But you will need to file taxes. You will need to file this 76 cents. You will need to file taxes for 76 cents. So in the end, you will end up paying 15% on this, which is like 7 cents, let's say so. So instead of just not worrying about anything, not paying your tax investment, tax professional, he will also take money, just basically invest in VOO. This is as good as it gets for now. You may save a couple of dollars, but you will need to file taxes. You can do it yourself. Okay, congratulations, you just saved $1.50 to $2. But if you cannot do it yourself, you will need to hire a tax professional. I don't know how much they'll cost, $50, $100. I never used tax professionals. I was always filing taxes myself. So, and that's it. I think it is not worth the hassle if your investments are like no more than like 10,000, no more than 50, no more even than $100,000. If you're making 6-7 digit investments, okay, then you may dig deeper. But for now, for our level of investments, just go with VOO and you'll be definitely good to go. And okay, so these were all the questions from the week I'm checking right now. Yes, So basically, if there are any more questions related to this meeting or anything else you want to ask about investments, feel free to ask. I'll give you 1-2 minutes. Use chat, use microphone, use whatever you want, whatever is more convenient for you. I will answer the questions, and I guess we'll end it. Almost already, what, 1 hour, 50 minutes already passed. And this was, yes, investment for the beginners, our second meeting already. Next meeting will go something about the, oh, Diego. Unmute. Yes.
Yes, I just wanted to ask you, because difference between what you said to invest individual companies and ETFs, the difference between the both?
Difference between individual companies and ETFs, you mean?
Yes.
So ETF, it is one investment for all. That's it. Like ETF is the portfolio. For example, my portfolio, okay, it has 14 companies. Let's say, so if you give me money, so I invest on your behalf, but I invest if I invest buying the same 14 companies. Like for you, my portfolio is an ETF. This is portfolio. So this is what is ETF. This is already a combination of companies. And different ETFs. There are ETFs that track the whole market. So they have shares of every single publicly traded company. The most famous and my recommendation are ETFs of S&P 500. This is 500 biggest US companies. There are ETFs which only invest in socially responsible companies, which are companies that are not producing cigarettes, not producing weapons, good green companies. There is even these companies, ETFs which only invest in specific countries. There are ETFs which only invest like in gold producers, in the companies that are related to gold. There's ETF for everything, like literally for every single thing. There's ETF just for small companies. If I'm not mistaken, Russell 1000 is called, if I'm not mistaken. These are 1,000 smallest companies of the US, publicly traded. There's ETF for everything. And this is assembled for you, portfolio, and managed for you. No need to balance, no need to edit, no need to adjust, nothing like this. Just invest, learn more about investing. And if you want, like me, invest in individual companies, you just sell your ETF and just start building your own portfolio, which is going to be more interesting for you, I hope. So this is the difference, basically.
Oh, okay. I got it. Okay, so ETFs are groups of companies.
Yes, this is portfolio. Yes, basically this is portfolio.
Okay, and are there? Oh, continue.
No, you can go. I was about to say the same thing already said. So.
Okay. Are there ETFs on commodities?
Like something like oil, gold, yes. The ETFs even for these things. Like I'm obviously not dealing with any commodities at all, but there are ETFs, like I said, there's ETFs like for like gold, yes, for silver, for oil. There's ETFs for commodities, or there is also ETFs for gold, but there are not gold commodities, but like gold producing companies, gold miners, gold like jewelers, I don't know, let's say. So like I was never investing in those ETFs, but I've seen them exist. So yes, there are ETFs for commodities that just like gold, and that's it.